I recently was asked by one of the members of my community if I could explain how I would use the stock symbol SOFI or SOFI Financial Technologies to sell a cash secure put option. Now, if you don't know about selling a cash secure put, it's a great way to generate a weekly income, and it's so simple to do. So when I sell a cash secure put, I'm telling the stock market that I'm willing to buy 100 shares of a stock at a certain price over a given time frame. So let's say I like SoFi, the company. I really like to own 100 shares in my portfolio. Well, I could sell a cash secure put in order to get those shares into my portfolio. Now, SoFi is currently trading right around $26 per share at the time of this recording. But I don't want to pay $26 a share. I'd rather have the shares at a discount. So with the cash secure put, I can make an offer to buy 100 shares of SoFi at $24 per share. And my offer is good for the next 7 days. Now, the offer that I just made is called selling a cash secure put option, because my offer is to buy 100 shares at $24 per share over the next 7 days. Now, the $24 I specified that I want to pay, that's known as the strike price. So if the market price dips down to my strike price or below, then the option contract would get exercised. But if the market price stays above my strike price, or that $24, then the option contract will expire worthless. And the 7-day period that I specified that the offer is good for, that's known as the expiration period. And the actual date when that 7 days occurs, that's known as the expiration date. And that tells you how long my option contract is valid for. Because after that date, this option contract no longer exists. Now, because my offer is $24 per share for the 100 shares, I'm going to reserve $2,400 in my account in case the shares get assigned to me, and I'll be able to purchase those shares, right? So it's $24 per share times 100 shares, because each contract has 100 shares in it. I'm going to reserve the $2,400. Now, for selling that option contract and reserving my cash for those 7 days, I'm going to get paid an option premium. Now, the premium that I get paid, that money's mine to keep forever, no matter what happens with the option contract. So at the end of 7 days, if the option contract gets exercised and those shares get assigned to me, I'll use the $2,400 that I had reserved in my account, and I'll use those to purchase the shares, in addition to keeping the original premium payment that I received. But if at the expiration date, the current price of SoFi never reaches my strike price or below, then the option contract expires worthless, but I still get to keep the premium payment that I received. Let me walk you through an example to show you how it works. And keep in mind, this example is not a recommendation to buy or sell or do any options trading. So one of the first things I do when I'm looking to trade a stock is take a look at the chart in order to determine what is known as the support and resistance lines. So let me explain briefly what that is all about. So you can see I brought up a chart here for SoFi, and it's a daily chart going back to, looks like about the middle of April. So it's got some time on it, and really what we want to focus in on is the past few months, right? So if we go back to September, you can see where my cursor is now. September through today, November the 7th, we can see that the stock, as represented by the candlesticks, is largely trading within this particular range, right? So you can see support level here, right around $25.13. And a resistance just above $30, almost not quite $31. And so as the stock price changes throughout each day, you'll notice that as it approaches the support level, it tends to move up. And when it gets to the resistance, the stock price tends to correct and start moving down. And so this is indicative of, supply and demand. So when it reaches the support level, people are thinking, or the retail market at large tends to think that the stock is on sale, and so you start to see people buying the stock up. And then when it reaches the resistance level, you'll see some traders actually taking profit on the table, and so there's less of a demand. And as the supply increases, then with the less demand, the stock price will tend to dip. So we're seeing this, and it's called range trading, right? So as the price moves in between the support level and the resistance level, you can almost predict what the stock price is going to do at any particular time. So you can see today, the stock price is dropping down, it's dipping, and it's going to reach this support level. And so if we tend to follow the trend, and if the trend is any type of indication, we should see the price reach, somewhere around that $25 level, and then recover and start moving higher. And so this is one of the indicators that tells me might be a good opportunity to place a cash secure put. Right? Because if I'm selling a put, which is largely a bullish type strategy, What I'm expecting is to sell the cash secure put, let's say at the $25 price. So I'm going to pick a strike price just outside of the support level, right? So it'll be out of the money here because I'm tending to think that the price, when it reaches this $25 level, the price is going to start moving higher. And so I'll sell a cash secure put, say at 25 or maybe 24.50, fully anticipating that the price will never reach that level and that the option would expire worthless. Now, if it doesn't, and I get assigned the shares, that's okay. I do like SOFI as a company. And what I could do is, if I do end up getting assigned those shares, what I'll do is I'll immediately turn around and use those shares to sell a covered call. And I'll be able to collect more premium. So in this particular case, we see that the candle is red. So today the stock price is down. It's approaching the support level, which is good. And if we look at the RSI is right around 42. So there's a lot of good indicators telling me that this might be an opportunity for me to sell a cash secure put using SOFI. So now let's jump over to my trading platform and take a look at the actual option chain. So I've opened up the trading platform at my brokerage account, and we can see here SOFI Technologies, stock symbol SOFI. Currently trading right around $26. And what I'm going to look to do then is to sell a cash secure put. So I'm going to come over here and say trade SOFI options. And I'm going to be selling a cash secure put. And let's go 1 week out. I prefer to sell weekly trades. Maybe I'll go as high as a monthly trade, but in particular, or for the most part, I do like to sell weekly trades because I do like to collect premium every week. And I don't want to have my funds tied up, for longer periods. Largely because you just never know what's going to happen in the market, right? The market seems to be pretty volatile. And so from week to week, things are changing pretty dynamically. And so right now, I'm going with a weekly trade. So let's take a look. So I'm selecting sell a put. I'm going to go 1 week out. So you see November 14th, that's 7 days. And the current price is $26, or just a bit over $26. And if we look at the option chain, I mentioned I mentioned using $25 as my strike price. And if we take a look at this particular option, we can see it's got a delta of 0.31. So it's got a 31 delta, plenty of open interest and lots of volume. Last trade was at 58 cents per share as the premium. So I'm not real crazy about the delta, 0.31. What that does is it tells me that for every $1 that the stock price moves, this option price will change about 31 cents. The trick that some options trader use is they also use that as a predictor of what the stock price will actually do on or before expiration date. So in this particular case, there's a 30% chance that the price will actually dip down low enough and reach this strike price. The other way to look at it is there's a 70% chance that it won't. But let's go ahead and take a look at the 24.50 strike price. We could see a delta of 0.25. There's still plenty of interest. The last trade was at 42 cents per share as the premium, and the delta being at roughly 0.25 tells you there's a 25% chance that the stock price will actually dip down low enough to either reach this strike price or below, in which case the option shares will get assigned to me. But conversely, there's a 75% chance that the stock price will never reach this level, in which case this option would expire worthless and I remove my obligation, but I'd still get to keep the premium. So let's go ahead and take a look at using the 24.50 strike price, which is currently paying about 42 cents per share. Let's plug that into my cash secure put analyzer. So here's my analyzer. Today's November the 7th. We're looking for stock symbol SOFI and a strike price of November the 14th, 2025. So 7 days out. Now with a strike price of $24.50, it's currently paying a premium of roughly 42 cents per share. So if we walk through this trade, we can see that with the market price of $26.21, I'd be looking to sell one option contract, which would obligate me to buy 100 shares if this option gets exercised. And with the expiration date of November the 14th, that makes the length of this contract 7 days. Now out of that 7 days, 2 days are for the weekend, so those aren't actually trading days, but it is 7 calendar days. Now my strike price is $24.50, meaning that if the option contract does get exercised and I'm obligated to buy the shares when they get assigned to me, it means I need to reserve $2,450 as collateral in case the shares do get assigned to me. But in return, I'll receive an option premium of 42 cents per share. Now based off the current market price, if I do end up paying $24.50, that's a discount of $1.71 off the current market price. So if I like the company, SOFI, and I want to own the shares, Rather than pay $26.21 per share, I could pay a discounted price of $24.50 and save me $1.71 per share. And that represents a 6.52% savings, or a discounted amount. Now, for selling the cash secure put option, I'd receive $42 as the option premium, and that represents a return of 1.71% for this 1 week trade. So that definitely meets my criteria. So to execute this trade, I would go ahead and select it, and I'm going to say that I want 42 cents per share, and now I can review my order. So I just walked you through the 3 basic steps for selling a cash secure put, right? So step number 1, you find a good stock that you like and you do the research on it to review to make sure you understand what the stock is all about and whether or not you want to own it, and also to help you find a good entry point. Number 2, you actually submit the order to sell the cash secure put option. And then number 3, when the option contract does sell, you sit back and collect the premium payment. And now I just have to wait for the expiration date to figure out what happens, whether I get assigned the shares, in which case I purchase the shares for $24.50 per share, which is a huge discount off the current market price, or the option contract expires worthless, but I still end up keeping the premium. So selling a cash secure put is all about selling an option for a stock that you like, that you wouldn't mind owning in case the option does get exercised. Now, when you sell the option, you immediately collect a premium payment, which immediately gets credited to your brokerage account, and that money's yours to keep forever. So is selling a cash secure put something that you could do to generate a weekly income? Well, it's absolutely something you could do. And I just showed you the 3 easy steps to get it done. I hope you liked this video. I really enjoyed making it, and I hope to see you in the next one.